Chinese equities have been in turmoil in the past few weeks, with the Shanghai stock market suffering the second biggest fall in its history this Monday, before bouncing back again. The market turbulence has stoked fears about the state of the Chinese economy, one of the key drivers of global growth in recent years. Hello and welcome back to Analysis Review. With me to discuss what's happening in the Chinese markets and why are Alessandro Theiss from Oxford Economics and James Kynge, the FT's emerging markets editor. Welcome. Alessandro, start with you. Just what is going on here? I mean, we've seen sort of some quite remarkable movements in the markets and then responses by the authorities as well. But what's happening and what's driving it? Why is this happening?
We saw a classic momentum-driven equity boom last year, where more and more investors joined into equities and more money flew into it. And at the same time, a big accumulation of leverage. So a lot of debt had been accumulated. So when prices started to come down, these more leveraged investors had to sell their equity holdings to pay back the debt. And this accelerated a downturn. I think that's why we have seen prices fall so quickly.
Yeah, and am I right in thinking most of the people who have been forced to sell, a lot of them are private investors? So what we're seeing is a lot of ordinary Chinese investors taking
Yes, exactly. And possibly also households with weaker balance sheets that have joined at a later stage.
But is there, I mean, James, you come in at this point, is there a sort of proximate reason that's triggered this? I mean, there's been talk about whether it's in anticipation of US interest rate rises or whether it's just a symptom of overall unease about the state of the Chinese economy.
I think it is a bit of a mystery. I would say it's just a state of unease. There was a growing state of unease that this was a stock bubble, and there was a growing state of unease about the amount of margin, in other words, leveraged purchases of stocks. And I think one day it just toppled over in China. I don't think it was really related to global trends.
Right, but it's been enough also for the authorities within China, for the Chinese government, to take it seriously enough.
It's been a huge blow for the authorities because, as Alessandro says, the authorities invited the investors into this bubble. They encouraged them to take loans to buy stocks. Now the bubble has popped, and now the authorities are asking companies to buy their own stocks. They're limiting IPOs. They're doing any number of different measures to support the market, rhetorically as well, very much trying to support the market. And yet they're not being successful or not very successful. So it's a real blow to the prestige of the Communist Party in economic matters.
Right, I mean, that's a huge thing. But Alessandro, just tell me, do you think, picking up on that point from James, if this sort of turbulence continues and we keep, I mean, obviously prices then bounce back a little bit, but then if we see further lurches, I mean, could that spill over into the real economy in China?
I think the direct wealth effects should be more limited. So households, in general, only around 10% of Chinese households hold stocks. Most of household wealth is still invested in property. And even with those households owning stocks, there's more concentrated towards wealthier individuals. And also for companies, they do not rely a lot on equity financing to raise funding. So in China, it's still very much skewed towards standard bank lending. I think, but the biggest impact is probably on confidence. As
James, are you as sanguine as that about the economic effects?
I think the direct economic effects, as Alessandro says, will be muted. But the effect on confidence, I think, is really key because of what's happening elsewhere in the Chinese economy. The particular problem in China now is the investment is falling off a cliff. If you measure Chinese investment in infrastructure, property and plant and machinery, according to gross fixed capital formation, it's down to about 4 or 5%, according to research by Dragonomics. This is the lowest in living memory. This is really, really a big problem. And the reason that companies are not investing is because they don't have much confidence in the future. They don't see much of an economic pickup. So the confidence issue is at the heart of why the Chinese economy is performing so poorly. And this stock market issue is another big blow to confidence.
Right. And just do you see, I mean, sorry to push you on this, but do you see this going beyond China? And one hears of international investors or analysts saying what they're worried about is that, people look to China, see that there's something, not so good happening there, or that there's a confidence issue as you've described it, and they may, given this overall state of the global economy, then sort of draw back a bit.
My view on that would be it's kind of the opposite impact. China's stock market debacle will not have a big impact on confidence of international investors in emerging markets. But the weakness of the Chinese economy is having a very major direct effect on the actual economies in the emerging world, particularly Latin America, which is going through a really torrid time at the moment, because a lot of the livelihood of Latin America was to do with exporting commodities, particularly iron ore and copper, to China. China's economy is slowing so quickly it no longer needs anything like the amount it did before. So the effect from the Chinese economy on places like Latin America and Africa is very strong and very direct.
And Alessandro, finally, we're almost out of time, but do you think for the developed world, the sort of Western world, there will be knock-on effects?
I think we are in a situation where people more and more reassess the ability of the Chinese authorities to steer the economy. And I think, adding to what you said, that this will have knock-on effects on emerging markets, because if you reassess the potential of the Chinese authorities to grow, to create growth, that obviously will create direct effects on emerging markets, but also on secondary effects where investors put less money into emerging markets.
Alessandro Theiss, thank you, and thank you very much, James Kynge. And thank you for watching. For more on this topic and other stories covered by our analysis team, go to ft.com/analysis. Until the next time, goodbye.